In all the other markets, the buyer goes with money in his pockets, the seller comes with the commodity, and there is a physical exchange of commodity for money. In the stock market, this does not happen. In the stock market, neither money is paid nor is the share physically purchased at the time when the transaction takes place. Merely a deal is entered. Now Mithali decides, let me not get too greedy. This is the first time I've ever bought shares. Picks up the phone, tells the broker, will you sell these shares that you bought for me the other day today? By evening, the broker calls her up, says, I have sold your 100 shares at the rate of 300 each. Mithali starts calculating her return on investment. She says, I bought shares worth 20,000. I have made a profit of 10,000 over a period of 1 week. 10,000 profit on a 20,000 investment translates into a 50% return, but 50% return over a week, and there are 52 weeks in a year. So effectively she has earned 2,600% return. She realizes no business like stock business. What have I been missing out all my life? Now she had 20,000, but this time she is a far wiser investor. When the broker asks, how many Asian Tyres shares would you like to buy? She is about to say 200 when she says, buy for me 2,000 shares. With a bank balance of 30,000, she places an order for shares worth 300,000. Logic is very simple. Next day, the stock market, when it is more active, it gives more liquidity to your investment, which means anybody who wishes to sell will find a buyer, anybody who wishes to buy will find a seller. When the stock market is more liquid, people are more apt to invest, people are more inclined to invest. When people are more inclined to invest, budding entrepreneurs find it is relatively easier to raise money. People who have the ability, people who can make, people who can sell, but who don't have the money will find it easier to tap the capital markets, and therefore more entrepreneurs will come. And here is now one client of one broker who says, I have bought 300,000 worth of shares, but I'm not selling and I'm not paying. But on the other hand, there is a seller who's waiting for his money to come. And suddenly you find there's a bit of a discrepancy between the money that the stock exchange is supposed to receive and the money that the stock exchange is supposed to distribute. There are some people who find this as a wonderful opportunity. These are opportunists who are waiting on the sidelines, waiting for an opportunity like this to arise. And they tell the stock exchange, index represents the general direction in which the stock market is moving. Just because the index has gone up doesn't mean your investment will appreciate exactly at the same percentage. Your investment will appreciate at the same percentage if your portfolio is exactly the same as the scrips that make up the index. But chances are the index might be going up, but your shares might be falling, or vice versa.